Hello and welcome to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP, which is a full-service global law firm with over 50 offices on 5 continents and roughly 2,000 attorneys. Today, we're here to talk about investment and the latest innovations in health tech. We've got a fantastic panel of Mary Grove, who's a managing partner at Bread and Butter Ventures, Shubhra Jain, who's the head of healthcare investments at Tarsada Investments, and Sheetal Narayani, who is a general partner at Global Health Impact Fund. I'll let them introduce themselves in a moment, tell you a little bit more about themselves, but I'd like to talk first about what today's event is going to be like. So first, we'll have a panel discussion for about an hour, and then we'll take your questions for the last 30 minutes. Please, if you have questions as we're moving through our discussion today, use the Q&A function. We'll be monitoring those. I will not be monitoring the chat. It's up to the panelists if they want to monitor the chat, but I've got enough to monitor in the background as I'm not only moderating, but also running the tech. In line with that, today's event is recorded, which is terrific because if you miss some or all of it, so long as you have registered, we'll send you a link to the video after about a week, within a week of today's discussion. Of course, today is also not a confidential forum, so please don't share any confidential information here as it will be recorded for posterity probably. Additionally, I encourage you to complete the poll because we'd like to know who is here. And with that in mind, I'm going to let each of the panelists tell you a little bit about themselves, about their fund and the investments that they make in health tech. Maybe we'll start with you, Mary, since we've had you on the panel before.
Great, Jason. Thank you so much for having me, and thank you for tuning in today. Thrilled to be here and for this great discussion. So as Jason said, I'm Mary Grove. I am managing partner at Bread and Butter Ventures. We are a seed stage venture firm based out of Minneapolis, Minnesota, where, yes, it is extremely cold this week, but we invest all across the country, and we really focus on our thesis, which we call the Minnesota Home Field Advantage, which is investing in the core sectors that are the Fortune 500 and sort of enterprise backbone of our region. So specifically healthcare, the food system, and enterprise SaaS are the 3 areas that we focus on. I lead our digital health investing, and it is very focused on the software side of the healthcare industry. We've been actively investing since 2017, have a portfolio today of 71 companies spanning all across the country. And so the mission is, invest in the best companies everywhere and then support them with unique partnerships and engagement with our Minnesota ecosystem. We are home to Mayo Clinic, Blue Cross Blue Shield, Medtronic, 3M, United Healthcare, a whole host of healthcare organizations we affectionately call Minnesota Medical Alley. So I'm thrilled to be here with you. And in terms of my personal background and journey, I've spent the last 20 years in tech and early stage investing. So I began my career at Google for the first 15 years, where I worked on the IPO deal team, did early stage business development and emerging market expansion, and then built the Google for Startups organization. And then prior to Bread and Butter, I was an investment partner at Revolution on the Rise the Rest seed fund. And so just love early stage, thrilled to be here and excited to be part of the conversation.
Well, we're thrilled to have you back. Thank you for joining us. Sheetal, would you tell us a little bit about yourself?
Of course. Thank you so much, Jason. I'm Sheetal Narayani. I'm the general partner at Global Health Impact Fund. I'm also the CFO of the entire organization. A little bit about us. We started the fund 5 years ago. First fund, $10 million under assets under management, is fully subscribed, fully invested in 12 portfolio companies. We just had an exit 6 months ago. So still popping the champagne on that piece, but it's a very first exit, always a special one. As soon as we closed the fund a little over a year ago, we have just recently launched a new fund. This fund has a similar investment thesis, which is investing in digital health, health tech, medical devices. But this time, the difference is we are trying to go a little beyond US. And that is the new structure of the GP structure of the new fund, where we have someone like me who has a focus in emerging markets. I have a colleague who's based in Europe and focused on that market. And of course, we are based in US, which is our home ground, California to be specific. So for the new fund, we're looking at investors beyond borders, deal flow beyond borders, and hoping to really activate the global part of our brand. About me personally, I moved to US 7 years ago. I spent more than a decade in emerging markets, I've worked in Asia, primarily in Middle East and India. I've handled markets in Africa, Latin America. These have been my focus areas. I was in corporate finance, in mergers and acquisitions, done joint ventures in some very crazy war zones in Middle East, which has been a fun and an exciting journey. Moved here to be a part of the Stanford family and made the change into the VC world. No regrets. It's been an excellent journey. Look forward to interacting with some of you during the next 1 hour and a half.
Fantastic. We're delighted to have you here. We've had your partner, Gary Goldman, on a number of times. He's always a pleasure. Yeah. And Shubhra, please tell us a little bit about yourself, a little bit about your role as head of healthcare investments at Tarsata.
Yeah, thank you for having me, Jason. My name is Shubhra Jain. I am a physician by background. I started my career as a primary care doc and moved over to the industry side of healthcare and business side of healthcare a little over a decade ago now. First as an operator where I led product for a healthcare technology startup selling software solutions to hospitals and health systems, and subsequently as an investor at 2 different platforms, currently at Tarsadia Investments. Tarsadia, we are a partner-led fund. We manage about $3 billion in assets across various asset classes, public equities, real estate, and investing directly in venture and growth through what we call our VGP practice, venture and growth practice. I lead our healthcare investments team here at Tarsadia. We typically invest Series A and up, although we have sometimes flexed in seed or seed plus rounds. Typically, check sizes starting at 5, flexing all the way up to 50 in a single round. We have very long hold horizons. It works out well for health and bio companies, which typically take a little bit longer to exit. Works well with our flexible capital structure and long-term outlook. Yeah, very excited to be here and interact with some of you over the next hour and a half over this panel.
Well, fantastic. And for the audience members who are here today, please fill out the poll. We'd love to know who's here live. And if you're not watching us live, we'd love to, we're happy that you're going to be watching us on a time-shifted basis. I think it might be helpful just to get a flavor for kind of health tech and where we can have today's conversation. It sounded like, for example, Mary, you're focused primarily more on the digital health side. Sheetal, it's kind of more, I guess, digital health, maybe med tech, which would include some devices. And then Shubhra, if I understood correctly, it sounds like maybe you span the gamut of that and include maybe even stretch into biotech as well. Is that no?
No. So Tarsadia has had a biotech investing practice, and historically we're majority shareholders in some of the public biotech companies. We have done that very successfully, but we're not currently actively investing in biotech assets. We're waiting for some of our asset base to divest from that strategy before we make more bets.
Sort of rebalance the portfolio on that.
Right, rebalancing the portfolio on the biotech side specifically, but we do everything that gets close to it. So we do a lot of life science tools, R&D tools servicing the life sciences industry. So we'll do all kinds of technology adjacent to it, but not a single asset, small molecule biotech company.
Fantastic. Well, maybe we can start today's conversation just sort of a recap. We just closed out 2023, which I think overall for venture, as you look at sort of the data, or at least the data that I've seen, sort of seems be a bit of a regression, in terms of capital deployed, sort of closer in line with 2017, 2018 numbers, as opposed to sort of the big ramp up that we saw somewhat maybe surprisingly once the pandemic started. Be interested in your perspective if that's sort of what you've seen there, and then how has that sort of permeated in health tech as well? I mean, how's health tech been in 2023, and where do you see it going in 2024? Open question for anyone.
Sure, happy to dive in with some quick thoughts here, Jason. I think it was a very challenging year in the market overall, from later stage all the way down to early stage, largely due to the lack of liquidity, on the LP side too. So that went for both funds who were raising new funds and also funds deploying capital into startups. If you look at the most recent data that was just released last week, right, the total amount of digital health funding in 2023 was $10.7 billion, which is the all-time low since 2019, so in 4 years. And I think that's definitely emblematic of the tightening that we were seeing, both in terms of number of deals getting done, timeline to close a new investment, and valuations being quite investor friendly in this market, right? And so we feel optimistic, though we remain bullish throughout the last several years. And from Bread and Butter's perspective, we've seen significantly higher volume of deal flow and quality deal flow in 2023. So it's interesting. For example, in an average year, we would typically see 12 to 1,500 new deals a year at the top of funnel. Last year, 2023, we saw over 2,000. And I think it's a combination of some companies waited longer to come to market to raise capital, hoping things would improve. Others are raising seed extensions. We're seed stage investors, but seed extensions that are pricing more like traditional seed rounds. And so there is a lot of appetite, a lot of capital there on the sidelines. And we feel like even in the first couple of weeks of this year, it does seem like people are feeling optimistic across the board, including me.
I see you shaking your head. Yeah.
Yeah, 2023 was actually quite a funny and interesting year. Like Mary said, I completely agree. The liquidity has been tight. We have had more resistance from even high-risk investors. There have been much more discussions and much more risk averseness in the sense of making investments and actually holding on to the liquidity rather than in making strong investments. We were actually very surprised. It was also the year of our first exit, which was a bit of a surprise. And we won, while we did not really think it would come through, though it was in talks for a year and a half, and we knew the company, it was somewhere, it's in the sleep medicine area, was a good and a potential target, but we expected it would actually be 2024, looking at the market back in 2022. So yes, how I think 2024 might turn out, I feel there are more conversations that are happening. I feel investors are being, while they are still continuing to ask a lot of questions, but they are more forthcoming. They are getting a little less apprehensive. That is the vibe I feel. In terms of the deal flow, we are still seeing a very strong deal flow, but lower valuations. But there are some really good ideas and really good startups out there. But another phenomenon that I'm also seeing many startups that they have gone through is bringing in the concept of bridge funding. Rather than jumping straight from Series A to Series B or seed to Series A, there's been more bridge funding rounds. Series A1, A2, A3, A4, they are making their appearance more than a Series B. And more startup, which I think is a good idea. We have to stay afloat. We have to ride the crisis that is there right now. So it's a smart way to do it. I think this might now change pattern in 2024. At least we're hopeful.
Yeah, if I can comment on that, we are certainly hoping that this pattern changes in 2024. We typically only lead or co-lead rounds, set terms, take a board seat. So it's very hard for us to navigate this dynamic where in 23, I think a lot of founders were delaying raising proper rounds, proper priced rounds. They were trying to do all kinds of creative structures with internal support and bridges and whatnot. To avoid raising a round in a market that was unfavorable. But what we are seeing and hoping to see more of is that has finally come to an end. I think the insider support has tapped out. Insiders have propped up companies as long as they could have. Most of them have tapped their reserves. Companies initially we're trying to cut burn and extend runway, and there is only so much that you can do that, and they have reached the end of their potential and capability to do that as well, and keep running the business as like a bare bones business. So we believe that some of that was actually very good for the ecosystem. It needed to happen. Some fat got trimmed, and people's expectations around valuation got readjusted. But hopefully this is going to be the year where more people are coming back to market with revised, reasonable valuation expectations, more aligned with what investors are willing to offer. The only caveat there is that it is an election year, and typically election years end up being full of a lot of economic and financial turmoil, at least in public markets, which personally doesn't impact us much because we have a permanent long-term capital base, but anyone who's raising in the markets, including more emerging funds, especially more emerging venture funds, I think will significantly be probably impacted by that. It has been hard for emerging venture funds to raise over the last couple of years, I would say since 2022, basically, since the market turned. And from that perspective, we think that recovery might happen in 25 or 6. I don't see that market coming back in 24.
The funds market in terms of raising a fund.
Right.
Yeah. I mean, you looked at, I mean, my recollection of looking at like 2021, it's like 2021 and 2022. 2022 was like the second, biggest raise year. It's second to 2021, which was just a tremendous pop. Which actually sort of leads me to a related question, which is like, what are some, I'd like to maybe probe a little bit in terms of what some of the factors might be that will make this sort of an inflection point or sort of turning maybe out of a nadir. A few things that get bandied about from time to time are interest rates, and where, sort of relative risk and return. I think the public markets have been doing pretty well recently. I mean, as compared to early in 2023 and even towards the end of 2022, right? And sort of, we talk about LPs and liquidity and sort of they're managing their own portfolios. And for those who are listening, the LPs are the limited partners. Those are the individuals and entities and pensions and others who invest in venture funds. And so for a while, it seemed like there was a lot of depressed investment there because their portfolios were out of whack between sort of private investments and especially sort of venture and then also public. But also, what about, if 2021 and 2022 were sort of banner years to raise funds, in 2023, there was not much of a deployment, is there pressure also to deploy some of that capital? So that was quite a lot, but at least it was just meant to seed the ground to have a discussion.
I can take some of that. I think for the more established funds, I think a lot of the capital, what you're talking about in terms of 2022 being a bumper fundraising year, a lot of that capital really went to established funds, which raised a lot of very big funds, massive funds, which were significantly upsized from whatever their historical average was. And LPs were more risk averse in allocating to emerging funds. We definitely saw that. I think that will change, but it will probably take this year to readjust. I do think that there is significant pressure mounting on the massive funds that were raised to deploy, for sure, because last year, very few of them deployed. Last year, a lot of that capital was going towards preserving and maintaining and supporting portfolio companies. But obviously the new funds that have been raised, and just for the sake of information, usually you're conflicted in terms of you cannot invest from a new fund into your old fund's portfolio company because your new fund investors may be different and they don't want to be having to carry the old fund's portfolio companies and be indexed to those returns. And hence, you have to deploy that capital into new investments. And there's typically, most funds have a 3 to 4 year investment period, of which a year and a half has already gone by. And so they're definitely feeling the pressure, and the bigger the fund, the more difficult it is to deploy capital, especially when founders have hopefully learned their lesson and are not raising as massive rounds as there were happening in 2020 and 21. And they're being more capital efficient and more thoughtful about what they raise. So while that wisdom lasts, it will be difficult to write big check sizes and deploy massive funds.
Now, that is a problem I would love to have. We are having the exact opposite problem where you were right. So the funds that were there in 2022 did go to the big funds. They did not come to the emerging funds. So we have had 2 years where we have been having issues raising capital. So it's definitely a fact. I'm completely aligned with that. So that is actually how we mitigated that part. It was always a long-term aspiration to go beyond US borders. And it seemed like we did not need a reason, but the reason presented itself to us to go beyond the US and to explore other markets. Now, globally, things are actually very interesting. So Asia, specifically India and Middle East, are 2 markets that I'm seeing are very aggressive. There are aggressive investors who are looking to invest in beyond their geographical reach too. And I have met a couple of investment bankers and investors out in the Middle East who are like, why are we not collaborating and connecting much more? Yes, there was a pandemic, the borders were closed, people were not really interacting, but the beauty is it did bring in digital communication in the forefront. It's easier to connect now than it was before. It's not that we never had the tools, but it's like every time you do not need to take a flight and it's easier to do it. Yes, of course, when you're finally closing, you need to be there. But globally, investors are more interesting in the Asia. Europe is, I would say it's a mixed bag. We have our partner in Europe has been giving mixed reactions how it's coming from the market. There are some investors who are risk averse because yes, they follow the US market very closely. And if investors in US are risk averse, that the trend does follow. But having said that, it's not there's not blind following. There are some who are still more curious, are willing to have discussions and communicate much more and see how it is going. And they also look at it as an opportunity to invest in US startups and the ecosystem. So it might be a time to think a little differently. And we are hoping this strategy works for us.
I think a lot of wisdom has been shared already. I'll just add on, I agree that the asset class that we're investing in, we do commit to our LPs roughly, plus or minus 7-year hold period. We're hoping to return capital. And so if you do sit on the sidelines for that long without deploying, I've heard from a number of LPs that, hey, I'm invested in a fund. They haven't written a check since 2019, right? That's 4 years later. I mean, you're supposed to return capital in a few years. And so it is a pressure point that I think is a positive from the perspective of startups seeking capital. I also think there was a huge rush in the beginning of the pandemic, right, of generalist funds investing in these large sectors of the food ecosystem, the supply chain, healthcare in general, right? Generalist investors moving into these categories and have now pulled back to some extent. And those who are really focused on it are still there. There are fewer funds and a fewer smaller pool of capital, but that really is sort of, I think it's not necessarily a net negative because you will partner with people who really are immersed in that industry and really do have a true focus in there. And I'll just reference, tech-enabled care delivery is a category that we love. We've made a number of investments in, and there we have to understand that the margin profile of a tech-enabled care delivery company, the gross margins are wildly different than an enterprise SaaS software, pure software play. And that's where a lot of, I feel like the first check, went in and it's sort of like, well, even best in class margins, let's say in the 40%, are never going to be software margins. And so there's that natural tension of generalist versus specialist sector specific investment.
And I guess sort of you brought up sort of the pandemic and maybe how that begat a sort of a shift or maybe increased turbocharged an appetite for particular categories. I mean, did you see that in sort of digital health and telemedicine? And yeah, you're shaking your head. And do you feel like there's kind of it sounds like there's a pullback, at least from the generalist funds, but do you feel for those who are specialists and have always been there and intend to be there, do you feel like that there's a groundswell still, like those folks are this continuing to grow, or have they also retreated as well?
I think that many of these technologies and innovations were already part of the industry, but really accelerated adoption, right? So telehealth is an obvious one as applied to so many categories, right? Remote patient monitoring, in-home care, public policy with respect to healthcare policy, just a huge area of interest. And so we saw a lot of innovation happening. That innovation is still happening, yes. It is more difficult to get funding, though. And I think, the way that I kind of think of it, we're seed stage investors. We do follow on invest, and we love to try to help support with introductions to the journey. And curious what, my colleagues think here. But in our mind, we're kind of preparing for, we can raise a seed round, we can raise a strong Series A, and by Series B, could we potentially be cash flow positive or break even to control our own destiny? Because my experience has been that it's very hard to raise later stage capital right now for tech-enabled care delivery companies. And just one example of the innovations there, the need is there, businesses are booming and growing. We don't yet have the answer. What we haven't seen since the pandemic began are huge exits in this category, right, within digital health. And that's either going public or M&A. And that is sort of the little bit of the holding of the breath moment, because we do need to produce those exits to create that virtual flywheel. And so I think there's a lot of opportunity, and some of those exits have just been delayed across the board, but it's a very interesting next couple of years here.
Well, thank you. So one thing that we typically do, and that we do a little bit earlier, is we sort of complete an audience poll, and I'm gonna close in, just share who's sort of on a percentage basis who's in the room today. But we've got a strong contingent from the Bay Area and California, with a total of roughly sort of 40%. Quarter from the rest of the US, 15% from elsewhere in the North America, 10% from Europe. So thanks for staying up. And same with Asia and Africa. And then in terms of the room, is populated by roughly 37% first-time entrepreneurs, so and 22% in early stage companies. So for those folks who haven't gone through this before, I think it's always helpful, and I think the panel is doing a good job sort of unpacking a lot of the jargon and also some of sort of the arcane terms and other things that we use in venture capital. And we've got 20% roughly serial entrepreneurs, and a few angels, some folks in government, some folks in academia, and some folks who are doing something else. So whether you're watching us live or on a time-shifted basis, we're glad to have you with us. I'd love to talk just a little bit more about sort of hot topics and categories in terms of, where we see maybe, if there's been a shift back, from the generalists in digital health and telemedicine and some of these other things that COVID turbocharged, like where, what is the next hot thing? Is it AI? Certainly 2023 seemed to have been a year of AI in tech in general. But sort of what other technologies are sort of ripe for development that you're seeing?
I think I like to think of it more as, what are the problems that are top of mind? That framework, at least personally for me, is often more helpful in figuring out if we are building, if we're just looking for a nail, we built a hammer and we're looking for a nail, you know what I mean? Very often it is possible for people to build too much technology to solve problems in healthcare that are not really technology problems. That may be policy problems or incentive misalignment issues, or a variety of other reasons why they exist. And they may or may not be, technology may or may not be the best way to address them. So if I think about more from a problem-based perspective, what is top of mind and what is more pertinent in this day and age, I think one big one that is screaming at us from every angle is healthcare workforce shortage. Physicians have quit their jobs and quit clinical practice in numbers like no one has ever seen before. No one that I know who's a doctor wants to practice and see patients anymore. It is a dire state. These people have gone through so much training, and they've dedicated half their life to get to this place where they can take care of patients. And our system has somehow managed to burn them out, to completely disenfranchise them, and they have they feel like they're getting the short end of the stick, and they're not really doing the job that they signed up for, and they're spending a lot of time on a bunch of administrative stuff that, quite frankly, is just below their pay grade, and that's not why they became doctors. Same thing with nurses. After the COVID crisis happened, we have seen nurses quit workforce in record numbers. And most hospital systems across the country have had to raise nurse pay to attract staff, and the retention of staff has really gone down. They're looking at a lot of travel nurses and people from other countries filling those gaps, and all kinds of creative strategies, right? So anything that is reducing the administrative burden on our clinical staff is super exciting. And a lot of times the solution could be technologies that use AI. Sometimes it's just a workflow tool, which was not available before. And we've seen companies that are doing these AI assistants or AI co-pilots for submitting the paperwork to payers, either before you see the patient, for example, for benefit verification or for prior authorization, or even after you see the patient for coding or billing. We invest in a company called Fathom that does AI-assisted medical coding. So typically hospitals have hundreds of coders that are either employed in-house, or they outsource this to manual coding services agencies who have somebody sitting in Philippines or Bangladesh coding, looking at all of the electronic medical records and coming up with what codes should be applied for billing. And this company is automating all of that, Fathom. So there are solutions like that that are very interesting, which can either assist or enhance or enable, or maybe even disintermediate some of the workforce within the healthcare ecosystem. That is something that we are very actively looking at from an investment perspective.
In terms of what for our investment ambition, we definitely, there are two areas that we think are interesting. Telemedicine and digital health it was a need of the hour with the pandemic coming in, and it's here to stay. I mean, we did have digital health before, but then actually improving the technology to the next level, where remote patient monitoring, accessing your doctor remotely, these aspects are still continuing. Even though the pandemic it's a very tricky question. Is the pandemic over or not? But the thing is, it's under control. We are definitely going out much more. And we are a little wary. Every time there is a news where there is a spike, we tend to get a little, tend to backtrack a little bit. But connecting virtually and accessing, having telemedicine tools handy, this is our new reality, and it is here to stay. And the way I see the startups which are going to be improving this technology, making it easier, and most importantly, HIPAA compliant, are the ones that are going to be successful. Another piece is AI. AI, we look at it with a pinch of salt, because there's so much discussion that is going around, and there's so much hype. AI has been around for quite some time, and it is only going to get better and better. The pace, I suspect, may not be as accelerated as the market perceives it. It will be higher than before, but not the concept of that AI is going to take over the world. I don't think that is true. That is, I think, a bit extreme. But yes, technology is on the AI front also going to get better and better. And it will be an interesting space to keep an eye on.
These are all fantastic insights. I think I would add from the bread and butter perspective within our healthcare investing, our sort of North Star, if you will, is to invest in technologies that democratize access to quality care for all. That's our North Star vision that we map to time and time again. And so within that, there are so many different areas, ranging from, as I spoke about earlier, some of the actual care delivery, tech-enabled care delivery, to the healthcare SaaS, pure infrastructure, that powers the plumbing, if you will, for health systems, health plans, et cetera. And we're in the process right now of we're about to publish our 2024 health tech thesis in terms of our proactive hunting areas. And to give you a preview there, thematically, it's one theme is this concept of access to care, and that goes to both rural, urban, with respect to affordability, right, being insured or not, telehealth as a mechanism to allow clinicians to expand their footprint and reach people in areas that maybe aren't currently accessible. So that access to care is one big thematic focus. Two is this focus on labor and workforce, which so many pain points that Shubhra just mentioned as well. And so that how can we use technology, whether it's AI, other forms of software, to really help streamline, create efficiencies, improve quality and outcomes by tech enabling. That's a big one. The third big theme for us is really around payment models, payments, and the fintech layer. So looking at the fintech layer of healthcare, including different go-to-market models for digital health companies, ranging from the employer to B2B to B2C to direct to consumer, right? So how do you think through the new types of contracts and partnerships that can be structured? How do we think about revenue cycle management? How do we think about more efficient billing and payment for the patient experience as well? So that whole payments category. 4 is just population health and targeted care, especially to populations who've historically been underserved or just been underinvested in as a category. And so we continue to be very, very keen to do more in women's health, behavioral health. We have a number of investments. Today, Delphina, for example, in our maternal health space is a smart platform for pregnancy care, maternal fetal monitoring, brilliant team in technology. In behavioral health, we have a exciting investment in a company called Options MD in the severe mental illness treatment resistant space, Your Path in the substance use disorder space. So that whole category of behavior. Again, the silver tsunami, right? The aging in place, aging in home, just a huge, huge opportunity that's only going to continue to have enormous tailwinds. And then the last bucket is around preventive care and what can we do to get ahead and look at a person's whole ecosystem, and so social determinants of health and whatnot. So those are some of the thematic, as we think about our 2024 thesis and beyond, that we're really, really excited about.
Thank you. And Shubhra, I think it's very interesting, and I've heard it also sort of parsed this way or viewed this way, but in terms of framing it as what are the problems you're trying to solve, I'd be interested in just understanding a little bit in terms of why you frame it that way. Is it because you're trying to find product market fit, or just areas, and whether or not it is something that is a fit for a market? I think it would be helpful for the audience, and I'm personally just curious.
Yeah, I think it comes from maybe two places specifically for me. I'll personalize this answer a little bit. One is I live in the Silicon Valley and I hang around too many people who worked at Google and used AI to do some photo sharing or something like that, and they broke their arm and they had to go to the ER and they were waiting there for 3 hours, and they're like, this is broken. Healthcare is broken. It needs to be fixed. I have so many skills and I can use AI to fix it. So there are too many companies that get born from this syndrome of trying to apply some technology that I know to a problem that I know exists, but have no in-depth knowledge or understanding of why the problem that I experienced exists in its form. Right. So the intentions are great. And would I rather have tech people going into healthcare? Yes, absolutely. We need them. But it takes a little bit of patience, and I would say healthcare is one where a more measured and thoughtful approach is warranted, because it is a very complicated system for people to understand. Even those of us who work in it completely don't understand it. So a more measured approach. I'm always very thrilled when I meet a founder who has either had a deeply intimate personal experience and grappled with a problem, or has taken the time to spend. I invested in a founder who worked as an EMT on the front lines and was That was not his original career path, but when he decided to build a company in healthcare, he took 9 months to go work on the front lines, see how things are actually done, what problems actually exist, talk to people on the ground, and then formulate his thesis and his product strategy, right? So I think that's one. The second place where it comes from is just from my own background and training. I'm a product of the biodesign program at Stanford, and one of the biggest strengths of the program, I think, is that they lay so much emphasis on solving an unmet need rather than finding an application for a technology when you're building a healthcare technology business. When the program starts, the first 3 to 4 months of the program are what we call need finding. And we rotate through various departments inside the hospital. We talk to various people on the ground. We do what we call observational studies and interviewing applying a very design thinking mindset to truly figure out what the issues are before we start brainstorming and prototyping solutions. And I think there's a lot of value in that approach rather than doing it the other way around, where we start with the technology and say, let's see where we can apply this. Because as human beings, we all have some degree of confirmation bias, and it's very difficult to overcome that when we're going through these exercises. The best way to overcome it is to leave it behind and to really go in with an open mind and ask just questions from a place of curiosity, not from a place of judgment, not from a place of trying to correlate or essentially connect the dots too early. There is such a thing as connecting the dots too early. So just being very observational and having that core design thinking mindset is something that's deeply ingrained in me.
No, that's wonderful. I mean, that makes a lot of sense to me. I've sort of heard it echoed, and also echoed, I think, I mean, you have a very interesting background being a physician by training. And sometimes we've had Sheetal's partner, Gary, on, who's a dentist and a doctor, and kind of all in one. And he has sort of, some that echoes with some of the things, the comments that he's made before too. I think it brings a very interesting perspective. And yes, healthcare is very, regulatory intensive as well. And, in terms of trying to bridge that gap of maybe the first problem that you have. I mean, sometimes I've heard venture capitalists indicate, well, then we look for a team, right? We want someone sort of inside the space and outside the space, and they're sort of better together. If you've got maybe a technologist and somebody who's got industry experience. Is that something, Mary, that you look for, or any of the panelists you look for? What do you look for teams?
Within teams specifically, yes. So investing at seed stage, it's so early that a huge factor, the largest factor by far in our decision, is really team. And we certainly have and will invest in solo founders. However, we do prefer to invest in multi-founder teams for this very reason, Jason, of having different perspectives, experiences, strengths, really being able to support each other through the grind that is early stage building, right? And so with respect to healthcare being a very unique vertical, we love to see multi-founder teams. And as a general lens, if there isn't a clinical or medical perspective experience on the founding team at this time that we invest, we would hope that there be a chief medical officer, medical director, chief clinical officer, depending on the type of business specifically. But really, when you're going to build a healthcare business, it is important to have expertise in-house. Certainly you will rely on advisors and partners and counsel, right? But really having that fundamental from day one. And so our sort of dream team formula can include founders of all backgrounds. And if you look across our portfolio, you'll see some who are clinicians by background, some who are really experienced sales and partnership people, some who are product or engineering technical people. But it is really about that mix of talent, but specific to healthcare, yes, having that expertise in-house, whether it's founder level or management team at the time at which we invest.
Yeah, and go ahead, Sheetal.
Oh, yeah. So definitely the team is very important for us when we are looking at investing. how's the team aligned, how are they coordinating well, their backgrounds, and the final idea. A couple of things that we look at more are what is the need that they're targeting? And bringing the loop back to the point that Shubhra made. Constantly, I'm a part of the same program, the biodesign program. And we do spend months in researching the unmet need. And it's such a critical part of the whole entire startup structure that is something that even instinctively, that is what I look at. When I'm looking at a pitch deck, I'm in a part of a pitch deck presentation. If within the first 5-6 minutes, I've not been able to understand what the product is and what need it caters to, or the service and what need it fulfills in the market, it is very hard for me to continue from there. From then, it is very difficult to make a comeback and then see, is this something that I would be interested in? One more piece, and usually I and Gary have a bit of a conflicting argument on this one. He has a very different opinion on this. So Gary is clinician. He looks at the same thing, the team, the unmet need, the technology, how it is going to go. The thing is that he's usually not interested in is looking at the financial model. He's like, it's too early. I agree, it is too early, but that is the point where I put my CFO hat on and I'm like, I want to look at the financial model. I am not looking for accuracy. What I'm looking for is in a comfort in building the concept of monetization, in building the revenue. And if there is an effort and a deep understanding of how this can generate revenue, it may be a few years later. I'm not looking for something overnight. I mean, at a seed stage, it's very hard to think of it as overnight. It's how comfortable is the team building this? Because tomorrow, and they're going to pivot a million times. A bit exaggeration, but they are going to pivot. So how they pivot and how they adapt to what the market, the curveballs the market throws, or while prototyping, if they have an issue, this model helps me understand their in-depth understanding of their entire business structure, of how it is going to go to market, because that is the aim. We want to see commercialization, or we want to see, even if there is an acquisition before commercialization, it's going to happen because there's potential for commercialization. So that is something I like to look early on. It's a bit of an unusual ask, but more times than not, I have seen many founders are really hands-on and they have it ready.
I think two things that I would want to highlight from what Sheetal said. I think the key operative word there being within the first 5-6 minutes, when she mentioned that, I don't think many founders realize an average investor is spending 45 seconds looking at a deck. And if it doesn't seem appealing, you may not get a meeting, especially if you're sending it by cold email. And this is not a knock against people sending stuff by cold email. I mean, I think all of us here are kind of an outsider in the venture ecosystem, right? Like, we don't look like what a venture capitalist would have looked like 50 years ago. And so we all have been at some point in our career and life in a place where we were trying to access a network that we did not come from. But I think you have a very short amount of time to be able to capture attention and interest from an investor. And being able to succinctly articulate a story around what you're trying to build and why are you the best person to build it, or why are you the best team to build it, within the first few minutes of any kind of interaction that you have with them, is literally the best superpower that you can have if you're raising capital. Nothing is more important than that. Storytelling is just as important. And this is specifically with respect to fundraising from investors. But obviously, there are many other ways to build a business, right? Like, you can bootstrap a business. You can. It may or may not be as necessary a skill to build a business, but it's certainly a very important skill to raise money. And most companies that are coming to us or that we are talking to are raising from institutional investors will need to go through this process over and over again. So one piece of wisdom there is to invest in it early, practice it with your co-founder, maybe get a coach. I think any investment that you're making in the storytelling aspect as a team is very much worth it.
I think that's absolutely great advice. And I know we've had this panel. Actually, it's been a while since I've had one of the healthcare focused panel or health tech focused panel, but different audience every time. And I think, a corollary to that, I know Mary has had some really good words of wisdom in the past on this, is just, doing your homework on your investors too, and knowing who is going to be receptive. And who's a good audience, right? And you can find out that I don't want to take I don't want to speak. I'll let the panel speak, but what are some ways that entrepreneurs can sort of build their funnel of potential investors and potentially qualify them before they even start sending out cold emails or looking for warm introductions?
Yes, I think that in this fundraising market, it's still a challenging market. And so I would just encourage entrepreneurs who are preparing to raise capital to do exactly that, really prep and put together a process to run an extremely tight and efficient fundraise if you can. And if you previously were anticipating having, 30 firms that you reach out to, try to put 90 in your spreadsheet and do their research, because it really is about more shots on goal in this market, just given some of the themes we discussed earlier about the tight capital market. And so what I recommend is come up with the universe of lists of potential investors, and then begin to really do your research, which is all generally, much of it can be found just through researching their websites, researching PitchBook, Crunchbase, other publicly available data sets, and try to understand, do they invest in your category, right? Are they the right stage? Have they invested? Look at their portfolio. Are there adjacent investments in your category? Are there competitive investments, right? And so sort of know that going in. Once you build that list, see who you have in common, shared connections on LinkedIn. Do they accept cold inbound? We definitely do. And we've invested in companies that we met through hello@breadandbutterventures.com is how you can, email in. We also have open office hours every week that we do, where any company in the world can sign up to meet, whether you're pitching a company or not. And so do firms have mechanisms like that you want to take advantage of? But really, the art of the intro blurb is one of the most overused, not pleasant sounding words, but the blurb, right? The half paragraph summary to understand very succinctly in 2 sentences, what does this company do? And then what are some traction metrics and highlights? And we work on this every day with companies to raise additional capital. And it's so-and-so is like your path is a population health solution for people with substance use disorder. Clear what they do, and then we're going to have just 6 bullet points. One that validates the team, any product metrics, growth metrics, revenue or rates of growth. Why am I going to take this meeting? And an investor spending 30 to 60 seconds reading through this may not even open anything that you attach. And so just really trying to capture the attention in a half-page email and personalize it. And so it's very compelling when we get an email that's, if you spend, a couple of minutes on our website, you would know that Brett, my partner, leads food tech, that I lead health tech. And so personalizing it to the investor, to the team member, and then referencing, hey, Mary, I see that you have a deep interest in women's health. I note your investments in Gabby and Nest Collaborative and Delphina. We're building an XYZ. So there are ways that communication layer and really helps you stand out, be best in class, and grab the attention.
I think that's great and very helpful advice. And as somebody who's sort of craft and trade, to come up with something short and concise often takes a lot longer than something long and sort of rambling. So it takes a lot of effort to be able to build it, but you'll get the return if you put in the time. So we've got just a moment or two left before we move into the Q&A session. I'd like to have this be an opportunity maybe for each of the panelists, if you've got a thought or a comment or something you want to share with the audience, as well as if there's good contact information, if you want to be contacted potentially by an audience member. Now would be the time to maybe share that with you, to share that with the audience. Maybe we'll start with Sheetal.
Yeah, sure. I'll put my LinkedIn information in the chat. Some of the last parting thoughts I would be like, I think this year would be the change that we see, and I would encourage startup founders, like Mary said, to increase the funnel and to reach out more to the investors that you think are investing in your area, in your sector. And for a VCs, I think we should definitely be looking beyond the traditional methods of fundraising and deployment. These are the last parting thoughts I have.
Fantastic. Shubhra?
I would just say it's a great time to build in healthcare. I think one thing COVID did was bring healthcare front and center of everyone's minds globally, from investors to tech companies to anybody in the ecosystem. There is plenty of capital available in the ecosystem, to your point of people having raised these massive funds, Jason. It's just an amazing industry. It can be daunting in the beginning for an outsider, but once you get to know a little bit, you'll see opportunity everywhere. One person's challenge is another person's opportunity. So if you're an optimist and if you're in it for the long haul and motivated by a mission, then healthcare is your place to build.
Wonderful. Is there contact information or like LinkedIn? Is that a good place? Or
I'll put my LinkedIn in the chat as well.
okay, great. And Mary?
Sorry, I was just pulling up my LinkedIn profile as well. Yes, it was an honor, pleasure to be back here again. And it's such an enormous opportunity to be building in health tech always, but especially now. I think that there's this question of, is the pandemic over? In many ways, no, right? It has surfaced a lot of opportunities and vulnerabilities and everything from supply chain to care delivery to underlying payment models, business models, to just broader population trends. And it's a blessing. The silver lining, I think, is to have some of those more attention, more capital, and more smart entrepreneurs building to solve some of those largest problems. And so my words of encouragement are, if this is your chosen category, it has been a tough 18 months or 2 years, but the sun will rise. And if you look historically back at the last 2 recession cycles, from the .com and from the Great Recession of 2009 era, companies that were started in those times of where constraint breeds creativity are some of the household names that we now know, right? Venture fund vintages in those eras were also significantly outperformed the years around it. And so there are some benefits to this time. And I would say if you've chosen, this is the time that I think the true grit and tenacity is really required and hopefully really rewarded. So encourage you. And from a bread and butter perspective, I will put my LinkedIn in the chat as well. And then I did reference our open office hours that we do. So I'll put the link, it's on our website, but you could book time with a specific team member. We all do open office hours once a week. That could be anything from want to learn more about venture, want to look at a financial model, want to actually get advice in a fundraising pitch a company. We would love to be a resource to you.
Well, thank you very much, panel. I really appreciate it. We're going to pivot to the Q&A section of today's conversation. In doing that, please use the Q&A function, the question and answer function. We'll be monitoring those. I won't be monitoring the chat. And what we'll do is we'll take sort of questions of general applicability, and we'll give it a shot at trying to answer all of them. And if we run out of questions, well, we'll give everybody a little bit of their time back today. So first question I can answer: Will the recording be available? Yes, the recording will be available. We can send it to you after the program. And my contact information, feel free to connect with me on LinkedIn, or if you want to send me an email, it's jason.gordon@klgates.com, but please don't send any confidential information. There's a question about having the panelists state the contact information verbally, so it'll be on the video. I think just simply go to, right, each of you, if you just search under your name on LinkedIn, right, I'm sure that your name will pop up. So I think that can take care of that. There's a thank you to the speakers for your time. So we do appreciate your time. Sorry, did I mention I'm multitasking and I'm a terrible multitasker? This is maybe an interesting or a question that relates to a particular sort of segment within health tech, which is in mental health startups in that space. And there was a lot of growth, I think, both on the true healthcare treatment side, and then also maybe a bit on the wellness side too. Those, and sort of the distinction is one is sort of therapy, one being sort of therapeutic, another is just being sort of, I think, to improve general overall life and wellness. Do any of the panelists have a view on whether that space is oversaturated at this point, or do you think there's still opportunities in the mental health sort of sector?
I can speak a little bit about that. I think Mary mentioned this. They have a company in the serious mental illness space. I think that is a space that is significantly underserved, continues to be significantly underserved. If you have a serious mental illness problem today in the US, your only option really is to go to the ER. And then they keep you in the ER for 24 to 48 hours, do an assessment, and then enroll you into a program that starts weeks later, because you have to be on a wait list for enrollment into these programs. So we have looked at a couple of businesses in that space as well. And I think while there are many so-called teletherapy companies that have come up, which are basically marketplaces for therapists to be able to do online sessions, therapy sessions for people, which is also underserved, and there's definitely a need for that. But while there is a lot of tech platforms doing that, there are not many that have had the stomach to take on serious mental illness, which is a much bigger initiative. And even within, like, there are other areas within mental illness. For example, postpartum mental health, postpartum maternal mental health is a huge issue that there are very few focused solutions that are understanding women's health at a deep level and being able to offer that. Group therapy is another one. There's just such a huge mismatch in the supply and demand on therapy. There is one therapist for every 622 people in America. And so if you're really going to make therapy available and accessible to the general population, one of the big solutions for access and cost is group therapy, and there's just not enough happening on that front. There's also eating disorders. I think there is a lot of demand for solutions for eating disorders, especially in young adults and teenagers. And while there are a lot of services-based organizations where you can go get admitted for these problems, there are not many technology-oriented virtual programs available for that specialize in those kinds of things.
I would add, Jason, I think that the current, mental health is one of the greatest public crises of our time, spanning from, children all the way through adulthood. And it's promising to see many companies building when these spaces are crowded. From a startup perspective, that's a great sign, but there is certainly no winner take all yet, or even close to saturation in my mind. And, you could have 100 companies building or 1,000 companies building, but not all will scale and will eventually grow, right? Or are the right sustainable models. And so to me, it's an indication there's a lot of interest, there's a lot of demand, there's a lot of opportunity. And we know we need technology in this arena because the human power alone will not suffice to solve this problem. And so we think that there's so many untapped areas, and it's really exciting, but it's going to take some time to figure out everything from, the actual access to care to the affordability or the insurance coverage for it, and so much more. And so I'm excited about it. I think it's one area that we're deeply passionate about, and I would encourage, more investments in this area.
No, you're on mute, Chital.
Sorry, my dog was barking, so I had to go on mute. I don't have too much to add. I do align with my colleagues. One piece, I do see a change in the mental health space, and there's more awareness after the pandemic. Before that, yes, if you had an issue, you would try to address it, and that is how the market was. But now mental health, fitness is a part of our life, just the way physical fitness is. And even if you're not really having a mental health issue, it is also something, there's a preventative attitude that has come out in the market. And I feel that, so definitely the market is unsaturated. And as a matter of fact, there's a whole new market of mental health fitness that is coming up. Even if you do not have a diagnosis, you definitely want to ensure that you continue staying in good health. So I think that is also a very untapped, has untapped potential.
Thank you. I have, I think this is a great question of general applicability, but it gets to, I think, what investors are looking at. It's a question about revenue, and at what stage and when will investors invest in a company either pre-revenue or sort of once that initial product market is fit. And I think part of this, not to answer the question because I'm no one's tuned in to hear me answer it, but I imagine some of this has to do with the stage and what the focus of a fund is. And we've got a bit of a gamut here in terms of where everyone plays. I think it'd be great to talk about sort of what your fund, at least the way your fund views it, and maybe more generally how the market views, seed, pre-seed, Series A, et cetera. Chitale, you're off mute, so I'll let you go. Yeah, first.
I agree. I mean, it is definitely has to do with the fund's philosophy, the investment thesis. Like, for example, with speaking about our fund, in the first fund, our focus was in pre-seed and seed. So revenue generation was not a high criteria. We were looking at companies which had good potential for commercialization, but the revenue generation was not a deal breaker. In our second fund, we have continued with the thesis. We are still looking at pre-seed and seed, but now we are a little more aggressive where we want to see a more, if it is not revenue generation is not the stage where the company is at, when is it likely? Is the MVP there? Are the studies, the research done, and the product has a fit in the market? Is the regulatory aspect on schedule? Is there a proper plan? So yeah, it is depending on the fund and where they are at when they want to invest when it depends on what stage of revenue generation a startup is in.
Yeah, I think the thing I would say there is investors come in all shapes and forms. It's just about finding the right fit. You'll find whatever it is that you're looking for and whatever stage of the company that you're in. There are some people who will have more risk appetite than others. So just ask questions, do your own research, as Mary explained earlier in the call. Do your own research, ask questions to figure out if they are a right fit for the stage at which you are in your cycle of building the business. And if they're not, it's better to get a quick no rather than have them waste your time. So try to screen that out quickly, and if they're not a good fit right now, then leave the relationship on a good note and say you'll come back to them once you reach the stage that they're looking for. I don't think these no's are personal at all. The more you can take them in your stride and the quicker you can get to them, the better for you.
I love this question too, and I think it's such an important, like the broader macro question is venture capital the right form of capitalization for the business that I'm hoping to build as the founder? And to me, when the answers align, it's generally that, again, venture capitalists have raised capital from LPs. We're responsible for returning that capital. And so there is a financial return motive there, and there is a timeline associated with that as well. And there is a venture scale return as the goal. And so, for example, I'll give you into the mind of seed investors at our firm. It's, every investment that we make, and we're building a portfolio, right? And in the current fund will have 36 companies in that portfolio. The math for us of every investment we make is, do we see a path to potentially 50x return on paper, mathematically potential for this business? And that gets to market size, market timing, any regulatory headwinds, tailwinds, like what's going to really accelerate or hinder the growth of this business. And so there's the mathematics of that. And also the time frame of the business wants to exit, right? If you're building a business that you want to be multi-generational and pass on to your children and grandchildren, venture capital is not the right form because we're expected to hopefully have an exit and return that capital. And so with respect to revenue, that really comes in to us around, it depends a bit on the sector, but when we invest, typically we have a live MVP, at least minimum viable product of the product in market. We care a lot about utilization and engagement data, so revenue is not a requirement. I would say about 50% of the companies we invest in are generating modest revenue being $10,000 to $30,000 a monthly revenue at the time of investment. In health tech, that there's huge exceptions to that, right? Where the go markets are complex, and we know it could be 24 months before we monetize, versus my future of work investment in an enterprise SaaS category. So it really does just depend, but it is about that plan, not only having the plan, the model. We know the financial model will not be exactly as life materializes, but it's more about the thought process, the thinking, and the goal around rate of growth and where we'll be and how we will make money and in what time frame. And then the final piece there is just ensuring that we're raising enough capital to be able to unlock that next fundraise. And so if we know we're not going to be monetizing for 2 years, great. We need to raise enough capital for 3 years, right, in this round, and, or make it stretch. And so there's a lot packed in there, but I do think it's a really great advice is to research the investor, ensure there's alignment. There are all types of capital, from angels to family offices to traditional VCs to strategic investors, and it is no one size fits all. And my view here is the more classic VC, but I do think that alignment is super important.
Thank you all. I think that's been very, very helpful. And I think sort of in thinking of, I mean, one thing, whether it's 30x, 50x, or 100x, depending on what people look at, I mean, it depends on where you play, right? But that's basically sort of the power law, right? Doubles or triples by the A, doubles or triples by the B, doubles or triples again by the C, and that's kind of how you get there. And that's why it's a long-term play. And it's a little bit different as you get, further along in the company, but that makes a lot of sense to me. And thinking about that and thinking about sort of returns and competitive moats, there's a question about how important intellectual property is for health tech startups versus sort of biotech. Biotech, we think about patents. Health tech, obviously med tech, probably we think about patents, but, what are some of the other sort of intellectual property moats that you all think about before you invest in either a digital health company or maybe it's a, tech-enabled care delivery company? How important is the intellectual property?
To be candid, I don't think many tech-enabled care delivery companies really have too much intellectual property. Unlike if you're building a medical device or even a drug, you may have intellectual property to protect. Not to say that no software businesses can. I think there are software products that do have some degree of intellectual property, but certainly not on the care delivery side of things. It's usually in the secret sauce on that side is mostly in the execution, the business model, the LTV to CAC, how are you able to acquire as many customers as possible at as low cost as possible and keep them as happy as you can so they don't leave you ever. I think that's really the secret sauce for building a care delivery business. We do look for intellectual property moats when we're investing in, for example, life science tools, R&D tools. If you're building something that is a manufacturing technology for cell and gene therapy, if you're building something that is a proprietary way of sequencing the RNA and extracting some useful information from it. If you're building a medical device of some sort, those are things that have real intellectual property moats. We have seen a little bit on some software products, but usually for most of the digital health stuff, we're not really looking for or expecting to have an intellectual property moat.
And for the audience, just to kind of frame out at least the way that on the legal side, we'd probably take a look at. I mean, there is intellectual property, there's branding, there are trade secrets and other things, but we're talking about hard IP mostly, which are really patents, at least in that particular kind of case, something where, it's particularly defensible and for, maybe even a limited monopoly for a period of time, as opposed to being able to build a business that can take really advantage and exploit as sort of a first mover advantage, I guess, right? Being able to do it super efficiently and scale very well. Yeah. Any other, I was going to shift gears, but I don't want to, if Mary or Sheetal have anything to add. I don't want to cut you off. All right.
Oh, sorry. I've just.
Oh, no, go for it.
Yeah. It is important for us when we invest in medical devices. That is something we definitely look at. But the rest, I'm aligned with Shubhra for when it comes to software platforms and care delivery systems. IP is, I wouldn't say it's unimportant, but it's not as critical as it would be for devices or for drug and pharmaceutical products.
So, earlier it came up in the panel discussion, the surprise 2024 is an election year. And sort of without maybe getting into, anybody's particular choice or where they think they might be leaning, I just would be interested in sort of visiting what kind of uncertainty or what we're thinking about in terms of, the uncertainty that injects sort of into the market. and whether that impacts investment decisions. Sometimes there's been talk about repeal of the Affordable Care Act, and whether or not that impacts anyone's investment decision at this point, I don't know. But there's a question with respect to the 2024 in the election year and what impact that's going to have on health tech.
I would say a lot of healthcare is relatively resistant as compared to many other industries, right? And a lot of the issues that we're talking about in healthcare are bipartisan issues, like mental health, for example. Some of them are not, like women's health, unfortunately. But I would say it impacts more at the level of fundraising for emerging managers and for GPs, for raising funds from LPs, because it impacts, if the public markets fluctuates a lot, then the LP's allocation of public markets may overshadow their private markets portfolio, and that can impact how much they're willing to put in risk capital in private equities. But on a company level, I don't think it gets impacted so much by just this being the election year. Now, of course, the outcome of the election will impact what the world looks like in the next 4 years at least, and in the longer term, that will impact certain companies more favorably than others, probably. But I think that should be the high level of how we should see the impact ripple through the ecosystem.
I agree. I think, no doubt it'll be a fascinating year all around. And I do agree that healthcare is such a built to last category. And for funds who have dry powder capital to put to work, for a lot of the reasons that we spoke of earlier, I do think that we are going to see investments continuing to be made, deals getting done, companies being able to raise. It is something to be cognizant of, because you never know what happens. And so if you are planning to raise, our minimum, and this used to be different advice in 2020, 2021, right now I'd say if you have, 6 months of runway at a minimum, go out for your next fundraise. And if you're planning to raise capital this year and you need it in the fall, go out sooner if you can, right? Just allow a little bit more time and buffer in case of that additional volatility. And I do think from a policy change or regulatory change, we keep in mind that those are very long timelines as well before we see, immediate overnight change. And so I think it's prudent to just take the long view, and the problems that we're solving, or that entrepreneurs are solving this category, are here to stay regardless of who is at the helm of the administration. And so I do try to take a sensible and steady view to the market, and to the category, no matter the market.
Thank you. So there's a question, and I think Mary, earlier you mentioned, one of your themes, or the themes of your fund, is population health. And Chital, you mentioned, you're focusing even more so, I guess, on the global aspect of the global health impact fund. There's a question which relates, I guess, maybe more to health on a population level, and with respect to, either in the global south or in areas where healthcare is disrupted. Have you seen, or are you seeing any opportunities in those spaces that are interesting, of recent, and maybe even sort of tying it in? There's still a lot of geopolitical conflict, to say the least, in 2023 and 2024, unfortunately.
So I did spend a reasonable amount of, after the pandemic, 2022 and 2023 traveling. While when we were looking at the expansion plans, yes, there were a lot of investor meetings, but there were also a lot of meetings with the startups. One thing I definitely see is, for the issues that we are facing, a more of a domestic and a local startup is actually better equipped to handle it than, say, a company based in US or in Europe, if we are looking for a problem in Africa. the local founders are much more equipped and they understand the problem much better. Yes, it's easy for us to be here in California and say, yes, famine is an issue. How do we handle it? But honestly, we cannot handle it till we are out there. So it needs to be somebody at the grassroots level who understands it and honestly probably has even suffered from it to a point, who are well equipped to handle this issue. So how, as a fund where we want to support and be a part of this, is actually also make investments internationally. Interact, connect with these founders, understand their vision, understand the market from their perspective. And more often than not, it is really, really surprising with what they come up with. I had met this one founder who is working in Egypt to handle who is in the fintech space and figuring out a way to make cash transactions easier. It's not something I would have even known the problem existed. I would have been like, wow, we are in a digital world. How is this even a problem? But no, it is a problem in Egypt, even if it is not. So yes, these are some of the investments that we want to make, be there at the ground level and making these investments.
Well, great. So it looks like, unless there are any other questions, one last one, which I don't know, maybe I can answer. The question is whether or not safes are used in healthcare and health tech. I think the answer to that is yes, if it's the right tool for the job, right? So what's the right tool for the job? Typically, that's sort of pre-venture capital investment, although sometimes there are some pre-seed funds and some seed funds that will play in that space and be interested in safes. And it's for a company that is, intending to and sort of has the business plan to be venture backed and to convert and to do a preferred price round. That's when we see them. That's when potentially they're appropriate to use. Any disagreements with that, or?
Just to add to that, I would say in this current environment, we're seeing them a lot more often. To an earlier point that was discussed on the panel around bridge rounds, a lot of those are raised on notes or safes, where people don't want to price and value the company yet. So it's very commonly being seen amongst venture investors and even amongst some growth investors in these companies over the last couple of years.
Yes, we invest in quite a few. We're comfortable investing in the spectrum from convertible debt notes to safes to price rounds, and we're happy to price rounds and lead rounds too at our seed stage. But I jokingly called 2023, it was the year of the safe for us, right, in terms of, and typically those are often used right at that sort of pre-seed. We don't know the valuation yet. We don't have a lot of traction underway yet. And in this bridge round or seed plus, seed extension, A1, A2, whatever you want to call it. But we see that quite regularly. And just a statistic, in our portfolio last year, we had 16 companies raise additional capital, and all but 4 of them were safes as a data point. Not necessarily as the preference, right, but as the vehicle that made the most sense in the context.
Yeah, no, I think that's all helpful context. I mean, some other things that I see, it used to be, I don't know, 5-6 years ago, maybe 7 years ago at this point, safes were within the culture of Silicon Valley. Everybody sort of used and accepted them. You start moving outside of Silicon Valley and everybody wanted a convertible note because that's what they felt comfortable with. But it seems like, at least in my observation, safes have gotten a lot more accepted, throughout all of the US, and then safes or safe-like instruments outside the US too are used. Although I still see sort of for the international component, like international deals that are really early stage, kind of more convertible notes. Seems like people are still a little bit more comfortable with those. And part of I think why safes are used much earlier on. I mean, they're just generally more economical to get done. And again, as Mary sort of alluded to, it avoids having to price the company specifically. Now, one can get into the argument about whether or not the cap is a price, and kind of how that gets negotiated is a whole topic in and of itself, which we probably won't cover today. But that's sort of why we see safes. So unless anyone else has any other questions or comments, I think we've moved through all the questions, which good for us. I don't know if I've ever accomplished that before, and we're at about the right point in time. So I guess at this point, I'll say thank you. I want to say thank you to, all right, we'll bring it to a close and we'll shut it down. Give everybody a minute or two back. So I want to say thank you to Idea to IPO for organizing today's event. Of course, a huge thank you to each of our panelists, Mary, Shubhra, Sheetal. I also want to thank each of the audience members, whether you're live or on a time-shifted basis. And I want to thank my firm also for sponsoring today's event. And with that in mind, I'll let everyone get back to building their great companies. And I'll let you folks get back to your board meetings and other things that you have to do. Thanks again. Take care.
Thank you.
Great to be with you all. Take care.
Bye-bye.